You will listen to people constantly telling you you will not make it. You basically get to follow trends in the world, make ridiculously risky investments. There will be hard times. We will give you the money because that's what we do. Like, you're thinking about what to do in life, make sure to read about this.
Welcome to Maximus Odyssey.
Hey guys, and welcome to another, I believe, awesome interview. Today I'm here with Aleš Ducháč, an associate at Credo Ventures. Yes, that's correct.
Quick update. Today, Aleš is the CFO of Credo Ventures.
Yeah, Credo Ventures is an investment fund, for those of you that do not know. And we're going to talk about investment, his journey to becoming, to this sort of position at 29 years old, which is pretty young for investment funds. And yeah, I believe and I hope you'll get a lot of value from it. So, Aleš, where are you right now in summary?
Right. So my journey to venture capital, that's what it's called, like the industry as such, was not, I would say, a typical one. So usually people who work in this industry would tend to have a certain experience in investment banking or maybe in some other consultancy firms. And then after a couple of years working there, they would transition to the VC industry as such, because maybe they would gain also exposure to what it's like, and they would realize there's something like VC. Because I studied political science, but I knew that probably I would not end up working in that field. So I was always business oriented. When I was younger, I was playing computer games quite a lot, and I played this one game specifically that was called Diablo.
Yeah.
I'm not sure if you know it, but when I was younger, it was quite a big hit, and a lot of people played it.
Yeah.
But I didn't play it really for the game as such. But what I liked was the trading ecosystem that was in the game. So most of the time, I just exchanged items with people, and sort of I got the kick of getting a good deal and then like doing another trade, etc. So like already back then, I sort of knew that I had a business mind, even though
Probably not like consciously.
Exactly. For me, it was fun, right? I was spending free time doing something that I liked.
Cool.
But then retrospectively, I think, I knew back then, even in a way, that I would end up doing something like transactional.
Yeah.
So when
Awesome. And so right now in Credo Ventures, you pretty much find the best startups to invest to in
So
Europe, right?
yes. So we focus on CEE, Central and Eastern Europe. And we typically invest in companies that either are based or have significant operations in the V4 countries, so that's Czech Republic, Slovakia, Poland, Hungary, or Slovenia, Croatia, Romania, and Bulgaria. So that's our core focus.
Yeah.
And what we do is we typically invest in companies that are quite technical, IT companies, and quite early in their journey. So they might have a product, but maybe it's not working yet. And we try to obviously understand if it has potential and whether we think the team is right and whether they can execute the thing. And so we're just watching trends, and hopefully one day we manage to do investments, but hopefully we can follow the trends also by being able to invest in companies that we think are in industries that will do well in the future. So that's pretty much it.
Very cool. But you're definitely like one of the sort of more like most significant investment groups in like CE, right?
I would say so. Obviously, we're not the only one, right? Like there's a number of similar funds in the region, even focusing similar industries and similar countries.
Like what is the money range that you invest in?
Right. So we typically deploy, say, hundreds of thousands of euro up to smaller units of millions. Exactly.
Yeah.
It really depends on the stage of that given startup. So initially, it would be most likely a couple of hundreds of thousands. Later on, if we see that they're doing well or that they need more money, we can invest a couple of million if it's justified.
Got it.
And but it's also a function of the size of the fund. So because we want to have to diversify a bit at least. we do not invest in 1 or 2 projects. We have tens, so let's say 30 to 40.
Mhm.
Uh,
Per investment fund.
as a company,
Okay.
as Credo Ventures, we have 2 funds currently, and are in process of raising a third one. So we'll end up having tens of companies. So we're not just sort of high conviction investors that we would just choose 1 or 2 companies and
Yeah.
put everything into it. I think a certain diversification is necessary. But yeah, that's all we do, and the stages are usually called seed and Series A.
Yeah.
Also, in terms of the money range that we discussed.
So meaning usually not like just the idea, but usually the projects are
Exactly.
phase where they
They
have
need to have something
yeah,
tangible.
they have like either like a really good MVP or
Exactly.
running mode, right?
Or even, for example, early customers. They might not be paying yet, but that
Yeah.
does not need to be a problem necessarily. But it's,
So they should have like some customers.
yes,
Some product customers.
yes, I would say it helps. Also because you can validate it, right?
Yeah.
You can call them, ask them like, why are you using it? Why do you think it's so cool? Etc. So yeah, it helps.
Nice.
But we also invested in some companies that didn't have a product yet, but it was a very, say, technological one.
Mhm.
So we liked it because of the quality of the technology, and we didn't, at least for us to be convinced, needed customers at that point. But yeah, in general, of course, like anything that validates your idea helps.
Yeah.
And the customers are the ultimate proof of that.
So with you personally,
Mhm.
you said your journey like started with like trading and stuff all the way back.
Yeah, yes,
like,
maybe.
playing games. So how did it how did it transition or from playing games with Diablo
To get to
Trade-
the real world.
into us? Yes, it probably wasn't just like okay games and whoops jumping right into the venture fund.
Right.
What was the journey?
Right. So as I mentioned, I think that I initially studied something different, but later on I realized that I want to do something in business. Actually, proactively, I sort of sought companies that would help me on that path.
What do you study?
Political science.
That's
That's pretty far.
a little far.
I know exactly.
Startups.
So
Yeah.
yeah, but then I talked with my cousin who works in the same industry in London, and he told me about startups and about investing and how cool it is. And
So like
how-
first one from
exactly,
connections.
exactly. And he connected me to the company that I'm now working with. So I basically sent them an email, asked for a meeting, and discussed like, look, I really don't have any experience, but I would love to try it. Like, would you give me a chance? And so we agreed on an internship.
Nice.
I stayed with them for months. Then I ended up leaving the company because they couldn't hire me back then, or at least like
Yeah.
they said they were not really looking for people at that point.
Mm-hmm.
And
That was Credo Ventures. You were right down already.
exactly. So that was in the fourth quarter of 2013.
Uh-huh.
And then because I knew I couldn't stay, I looked for another job. So I managed to get to Czech Google, where I worked for 1 year. And after that 1 year, they came back, asked me for lunch, and at the lunch offered me the job, which I gladly took.
Cool. So
Because I enjoy working with them. So
working.
and I don't regret it. So
Yeah.
so luckily it worked out for both of us, I hope.
Yeah. If you're leaving Google, it sure as hell should be for a major
I mean-
fund or stuff like that.
Yeah, of course, but I was very young at the time, so it's a hard decision because they were quite different companies. Because I would say venture capital is sort of anti-corporate, whereas Google is becoming corporate, like more and more, if not already is. But it's simply a function of so many people working in one organization, so you need to have certain structure in place.
Sort of unavoidable.
Exactly. So I'm not saying it's necessarily a bad thing. It's just that ultimately the biggest difference that I was thinking about was what it would be like working in these companies, like day-to-day job.
Mm-hmm.
And so I sort of felt that I was young and that I wanted to try something different that I haven't experienced until then.
Yeah.
And VC was for me very new, very trendy, very very different. So I wanted to try it out. That's how
Big.
that's how I decided, that I actually preferred trying this out. And obviously, I couldn't be wrong. I could have changed jobs since then, but I ended liking it.
Very cool.
And as I like to say to people, one of the reasons that I like it so much is that because you basically get to follow trends in the world. And occasionally you have a chance to invest in a company that you think is really good, and also is sort of, you think, following the path of something that will be big in, say, 3 to 5 years. So, and that's exciting because you get to see quite quickly whether you made the right decision or not, because it doesn't take 5 years for you to see whether it was a success or not. But you can see it, say, in a year or two, whether sort of the things or the assumptions that you had about that company, about the market, about the trends are sort of coming true, or whether it will be a hard battle for them to actually achieve what they set out to do, and sort of become prosperous in the end. So,
Yeah, it's a very dynamic field, like,
Exactly.
to the startups. That's what I enjoy about it as well. Like, it's always something new. Like, even if you think you know what you're doing, you never really know what's coming for you in tomorrow, to be honest.
which is also, to be honest, quite frustrating. And with the 4 years doing the job that I do, I think I'm not sure I'll ever establish my own company, because
Really?
seeing so many startups being rejected on our part sort of makes it, like, okay, so if I want to be successful with my own business,
Yeah.
and I see like what the real percentage chance is to actually get an investment from a fund like us, it sort of like turns you down from trying to. I'm not saying I will not ever do it, but I just see how much harder it is than I think the general population might think.
Like launching or
Exactly, especially if you want to get an investor, right? Because some of the companies will not need it, or will not even want it, which is perfectly fine. But usually, companies that sort of want to be global or want to achieve some really, really big dreams of the founders, they usually will need an investment to get there, because they simply wouldn't be able to do it without external funding.
unless you're a very rich founder.
Yes, exactly. If that is the case, then good for you. You will not lose any equity. Oh, by the way, that's maybe I forgot to explain. So the basic transaction is that we invest money, and we get to own a part of the firm, not a majority. I would say we typically get, say, from 10 to 20% of the company, and then we function as sort of like advisors. Sometimes more hands-on, sometimes more strategic. It really depends on the phase of the project, on how much help they need, or how much help we think they need. But so our goal is not to control the company. We invest in the companies because we believe that the team in place is really, really good, and that they will be able to take it further. But we try to help them as much as we can, obviously, since we've put our money into them. So
you push your money where your mouth.
Exactly. And sometimes, to be fair, actually, it might be, in a lot of cases, you end up losing the money. I mean, if I were to talk about our funds specifically, I would say it's more evenly distributed. So it's not like we would have huge failure. Of course, we have some failures, but it's not like 9 startups would fail and only 1 would succeed. I think it's more even in terms of like some startups fail, some of them manage to get sold for a certain amount. Maybe you do not get the money back, but at least there's some value.
Because after like a certain stage, it's not like such an exponential.
Exactly. So you might decide, and they might decide as well, the founders of the company, to actually say, like, we've been doing it for a couple of years now, you would like to move on, so let's find a buyer. There might be a buyer, it might not be the greatest exit, but you still get some money on it, or maybe money back. It really depends on the situation. So this, of course, happens as well. So I wouldn't say that in our portfolio it would be the classic, or maybe like what's in the media. So like 9 startups fail and only 1 makes it. I think for us it's not the case. But of course, in general, I would say a lot of them will fail. So it's about finding at least some that will be able to return or actually make profit for the investors into the fund.
Got it. So when choosing a startup to invest in, what are like the basic or like the main criteria to look at?
So I would say I would divide it into two groups. So one would be the seed, the very initial stage.
Yeah.
And then what I call Series A, which means they already have a product that they're selling, they have customers,
Mm-hmm.
but they want to take it further. So that would typically mean a geographical expansion.
Yeah.
So for example, they've been doing well in the Czech Republic, but they realized that the product is really cool and there would be demand elsewhere, say in Europe.
Yeah.
So they'll open 3 new markets, which would mean hiring more people to be on the ground. I don't know, bigger marketing budget, investing more into technology to develop new features, etc.
Mm-hmm.
So for the initial stage, for the seed stage, it's really about the quality of the team. So we need to sort of believe that they have what it takes to make the company a success, but we also sort of need to be aware, or actually they should be aware of the fact that they're getting money from an institutional investor, which means we will need to exit from the company at some point, say in 5-6 years. So they shouldn't, and that usually happens via an acquisition, meaning a bigger company in that segment will buy them. For the technology, for the team, for the revenues, like whatever. But it means they will get acquired, and it will no longer be their company. So it's not for everyone, because a lot of people would say, "Oh, I will fall in love with my business, it will be my baby. I will never sell it," which is perfectly fine. But in that case, we're not the right partners. We're not the right investors, because we will take a part of the company, and we will want that company to be sold. It's not the only case. They can IPO, right? So they would never lose control. But to be fair, that doesn't happen that often. So
IPO meaning that the company goes public.
Exactly, public. So
you have a private company that you personally own and no one else can buy. If you go IPO, like initial public offering, meaning that you put like yourself on the market and people like from, I don't know, stock exchange and people on Wall Street can come everywhere.
But also people like us eventually.
And eventually people like us, yes. It's like publicly available
Exactly.
shares or like.
So that can happen. That can happen, but it doesn't happen that much.
Yeah.
And so they need to be cool with that. They need to be okay with the fact that their company, their baby, will be sold one day.
Yeah.
And if this sort of clicks out and everything's fine, we also need to see the market potential, meaning we have to believe that the company, if it succeeds, to put it bluntly, can return the whole fund, can give us through the acquisition enough money to pay back all the investors in full.
Yeah. So like you might have a fund of an X amount of money. You invest in like 20, 30 startups. Much of them fail, but for you to succeed, all you need is like one startup that will cover the whole X and even more.
For successful funds, it's usually how it is, especially meaning if the funds are, in our terms, successful. There would be one company, or maybe 2, that would represent, let's say, 80 to 90% of the financial value of the portfolio in the end. Meaning you would get 80 to 90% of money from that 1 or 2 companies that on the fund level. So ultimately all the sort of revenue or like the proceeds that would go towards the fund, it would be from 1 or 2 companies.
Yeah.
Which, in the beginning, it's like really hard to predict which one of your portfolio companies that will be. And to be fair, to have a successful fund, you do not need to find a ridiculously successful company. But in that case, you would need to find more of them, say 3, 4, that would give you a very decent return on your investment. So that's also fine. You never know what you will end up with. But obviously, you're trying to pick, hopefully, also other VCs and investors are trying to pick the investments so that they believe that at each and every company, if everything goes right, they can become really, really big, because that's the logic of the VC industry. Like, you make ridiculously risky investments, but that is sort of then paid off in the end if you manage to hit 1 or 2 that end up really doing well, and then the multiple on investment can be 10 times, 20 times, 50 times. Like, it really depends, of course, but
got it.
But that's the logic of the industry.
Yeah. Well, so like in summary, could you give a summary of like the couple things that you look at when having a meeting with a startup, or like looking at the pitch? What are like super basic.
Which actually reminds me that I haven't answered the question about the second group, but I'll get to it when answering this one.
Okay.
So for the early companies, we're basically looking only at these criteria. So the team and the market potential.
Team market potential.
Right?
Okay.
That's pretty much.
It seems basic, but it probably isn't.
I mean, I was saying the two main criteria. So,
Like,
of course, you consider.
Yeah.
Of course, you consider everything. Like, I don't know, the culture, whether they have the right technical talent, whether they have some product, whether they have some customers, etc.
Yeah.
But like, ultimately, in that stage, it's more important that we believe they can do it,
and
that the opportunity is really big. And that's actually what we're trying to find out during the meeting. So, if a startup sends an email, we reply, we set up a meeting. We talk to them. So for these initial companies, we try to understand what they do, why they think it's cool, why they think the problem that they're addressing is worth solving. And through that, we try to identify whether we also believe that the market is really big and that they're the right people to do it. If we invest in later stage companies, that will be the Series A companies I mentioned. On top of what I mentioned in terms of the criteria,
not like the ones at the very beginning, or probably already have recurring customer.
Exactly, already have clients, have revenue,
spending a sort amount of money.
Yes, or at least some, right?
Yeah.
Again, it can vary. But on top of what I mentioned, the criteria, we're also looking more in depth. So we're looking at the financials, because now we're also looking like whether financially it makes sense, whether they are, whether, I don't know, they're getting enough revenue from each customer, whether it makes business sense. We're also looking at the culture, like whether they will be able to make senior hires, whether they are able to attract top talent, because other people also believe that the company is doing really well. And so when you will be expanding to all the different countries, whether you will be able to attract skilled and really good people to lead those offices, for example, etc. So it's the capability of that, of hiring really good people, so that when that business in that given country is reliant on those newly hired people, that they will deliver, right?
Yeah.
So, and also, of course, we're deep diving more into the product. So we're checking like how solid it is, how big value it's bringing to the customers, what the competition is like. Because maybe initially for the seed stage companies, like there might be some companies that do something similar, but it's really hard to say when it's all been proven by the market, meaning not having customers.
Yeah.
But if you're looking at a Series A company, they are having customers, so you need to we call them, for example, and we ask like, so how happy are you? Like, why have you chosen this company instead of a different one that does a very similar thing? They opted for this one. So that's why. Like, is it because they smile, or is it because like you really think they've built better features? It's revolutionary in what they do, etc. So
you get like really, really deep research.
Yeah, of course, because usually in these later stages you're also deploying more money. So you should really make sure, at least in your head, that you feel that you're making the right choice. So of course, like we usually spend more time with the later stage investments.
That makes a lot of sense.
Yeah, of course. And I also think like in general in our funds, the split is, say, 2/3 would be the seed investments, the initial ones, and 1/3 would be the later stage seed investments.
Like with quantity amount of your investments, or
numbers, right?
Yeah.
So say
not like money value.
No. I think the money value
Probably bigger. And
the money value can be like 50-50, say, ballpark. But because you invest higher amounts into later stage, but you do more seed stage, but you invest lower amounts, it sort of equals out. And I think, again, like you cannot really predict it. From experience. You learn like how much you sort of need to keep also for follower investments, because then if some of the investments are really doing well, you need to double down usually, because you see that things are going well, so you should increase your exposure in the company and you should invest more, so that in the end, when you end up selling the company, hopefully you will have a significant stake in the company, so that the multiple on the money, on the investment, gives you a good return.
Yeah, that makes sense. Wow.
So that's what we do, and hopefully we'll end up being right about hitting some of the companies that will make it big. I mean, we have at least one that I can mention.
Mm-hmm.
It's actually our most successful company. I remember that when we invested, there was a bunch, I think 10 or 15 people in Romania.
Okay.
And so, like we like the guys, we like the product, but of course we couldn't be sure whether this could become something big.
Mm-hmm.
But now they're valued at $3 billion. We only took them roughly 3.5 years to get there.
From a valuation of a couple million.
Yeah, exactly. A couple of million in the beginning when we invested to
Like a-
3 billion right now.
Like a triple unicorn.
Which actually, on that topic, I think it's the fastest growing B2B enterprise startup in Europe ever.
Wow.
So that was one really good
Yeah.
investment. Of course, we have a lot of good ones as well, but
Congratulations on that.
thanks. Thanks, but it's not at the stage of this one yet. So
Yeah.
maybe one day.
Very nice. That was like a solid brand, definitely. A lot of knowledge. You might want to replay that a couple of times to understand like all the specifics.
No, I would definitely recommend, guys, if you're thinking about what to do in life, make sure to read about this because I think it's an industry that not many people know about.
Yeah.
Because it's not typical, and the teams in the industry are not big. So usually VC funds are usually, I would say, between 5 to 20 people,
Mm-hmm.
and they don't really market themselves and frequently invest in companies that are not sexy, meaning like it's not Facebooks, it can be
Yeah.
what we do, like B2B companies. So they might develop some cool technology that some other company will need or end up buying.
It was like this guy talking about transistors and measuring that the electricity runs correctly and stuff like that. Which is
Yeah.
not exactly like
Exactly. It's not cool at the first sight, but you might realize that in the end it's actually revolutionary and can change a whole industry in the end. So
awesome. Probably to wrap it up. For all the listeners or watchers right now, what would be your advice for people who are like starting a company and thinking about getting an investor on?
got it.
What should they focus on? What should they do?
So it really depends if you want an institutional investor like us, or whether you're actually maybe raising your very first funding round, and you would be happy with, say, tens of thousands of euros for the initial sort of validation and development of the product.
Mm-hmm.
So if you're early, meaning that would be the latter, you only need a couple of like tens of thousands.
Yeah.
Maybe try to find a person in that segment, meaning in the segment that your product will function, or a problem in that segment that your product will try to address, and try to find these people who have already succeeded in with their own companies, and maybe they have exited their companies and now are doing this as for fun. So maybe try to find these and try to raise money from these people because they should understand you because they've been founders once before.
Yeah.
And they will like it because they've they went through the journey. They understand the troubles. You need to be brave. You need to listen. You will listen to people constantly telling you you will not make it. Like I don't believe in it. It's not. You're not solving anything fundamental. So obviously you will need a lot of. You need strong will.
Yeah.
To push through the hard times, and there will be hard times. Even if you're a well-funded startup and you think everything is rosy, there will be hard times.
Yeah.
So maybe that's where I'm gonna begin, and then later, if you end up approaching an institutional investor, try to make it short. Try to make your case quickly because investors do not have a lot of time, and if you're efficient and can communicate what you do, why you do it, why it's significant, and why we should invest, then it can be 8 slides presentation. And I'm perfectly happy. It doesn't need to be an opus or 50 pages like why your thing is special. But then you'll get a meeting and we'll talk. And again, if we continue being impressed, then we will give you the money because that's what we do. Like we give money to interesting, clever people who are addressing world's big problems.
You heard it here first. If you want to talk to bigger investors, make it really short, like the elevator pitch, right? But probably
Exactly.
maybe even faster than an elevator pitch, like 1 sentence pitch, 2 sentence pitch. It's really important to
Especially
cover.
if it's an informal environment,
Yeah,
right? So if you're like talking like the two of us,
Yeah.
Of course, if you're sending an email, it can be a bit longer, but you have to be aware that we have short attention span. So
like a goldfish. All right. Thank you very much for
thanks.
sort of pushing or like funneling all this investment knowledge into
Happy to
me
have-
and hopefully the viewers. And we'll see you in the next one. Whew, investments. That's a big topic. We need to get that a bit more research. I'll see you soon. Peace.
Now, subscribe so you don't miss out on the next episode, and please share this with your friends if you think this could help them.